Housing prices keep rising, and most people think the biggest problem is how expensive homes are. But the real story might be something far more dangerous and much quieter. What if the solution being offered to fix affordability actually makes the problem worse? Because right now, in several countries and policy discussions around the world, lenders and governments are floating the idea of 50-year mortgages, and on the surface that sounds like relief. Lower monthly payments, easier approvals, more people able to afford homes. But what sounds like help can sometimes be a financial trap in disguise. And to understand why, you have to look at what long mortgages really do, not just to buyers, but to the entire housing market. For decades, the standard mortgage length has been around 30 years. That timeline was never random. It was designed as a balance between affordability and realism, long enough to spread out payments, but short enough that borrowers could actually own their homes before retirement. Extending that timeline to 40 or even 50 years changes that balance completely. Yes, your monthly payment drops, and that sounds like a win, but the total amount you pay over time skyrockets. A longer mortgage does not make a home cheaper. It only makes it feel cheaper in the moment. And that difference between real affordability and perceived affordability is exactly where problems begin. When buyers qualify for larger loans because payments are stretched out over half a century, home prices tend to rise even more. Sellers don't price homes based on what they cost to build. They price based on what buyers can borrow. So if buyers suddenly qualify for bigger loans, prices adjust upward. That means longer mortgages can actually push housing prices higher instead of lowering them. It becomes a feedback loop. Payments drop, borrowing power rises, prices rise, and now buyers need even longer loans just to keep up. What started as a solution becomes fuel for the problem. And there is something else most people do not realize. With a 50-year mortgage, you are often paying mostly interest for a huge portion of the loan. In the early years of any mortgage, most of your payment goes toward interest rather than the actual house. Stretch that timeline longer and you stretch that interest-heavy period too. That means you could spend decades making payments and still barely own any more of your home than when you started. Many people assume time automatically builds equity, but with ultra-long loans, time mostly builds profit for the lender. Another hidden risk is flexibility. Life rarely stays the same for 50 years. People change jobs, move cities, start families, face layoffs, deal with health issues. A mortgage that lasts half a century assumes stability that almost no one actually has. And if your financial situation changes, a long loan can trap you. Selling a home early in a long mortgage often means you have barely paid down the principal, so you walk away with little or nothing after selling. That limits mobility, career choices, and financial freedom. What looked like ownership can start to feel like a contract you cannot escape. There is also a generational effect. A 50-year mortgage can mean people are still paying for their homes well into retirement. Instead of entering later life with reduced expenses, they may still be tied to decades of payments. That shifts financial pressure from younger years into older ones when income is often lower and stability matters more. Home ownership used to represent long-term security. But if loans stretch across most of your adult life, that security can become dependency. Supporters argue that longer mortgages simply reflect modern reality, that homes cost more now and incomes have not kept up, so loan terms must expand. But that logic treats the symptom rather than the cause. High housing prices are often driven by limited supply, zoning restrictions, investor demand, and speculation. Extending mortgage terms does not fix those structural issues. It only allows buyers to tolerate higher prices. And when buyers tolerate higher prices, prices rarely fall. In other words, longer mortgages can normalize expensive housing instead of solving it. There is a psychological angle too. Humans tend to focus on monthly cost rather than total cost. If the payment fits the budget, it feels affordable. That is why subscriptions, installment plans, and financing offers are so powerful. They shrink big numbers into small ones. A 50-year mortgage uses the same psychology. Instead of asking whether the home price makes sense, buyers focus on whether the payment feels manageable. But manageable does not always mean sustainable. Historically, whenever financing becomes easier, asset prices tend to rise. We saw this with student loans and tuition. We saw it with car loans and vehicle prices. And housing follows the same pattern. When borrowing expands, prices expand with it. So if ultra-long mortgages become common, they may not make homes accessible. They may simply make expensive homes appear accessible while locking buyers into decades of payments. There is also the risk of normalization. Once something extreme becomes standard, it stops feeling extreme. A 50-year mortgage sounds shocking today, but if enough lenders offer it, it could quickly feel ordinary. Once it feels ordinary, buyers may stop questioning whether it makes financial sense. They may assume it is just how things work now. That is how structural shifts happen. Not overnight, but gradually, until what once sounded alarming becomes routine. None of this means long mortgages are always bad for every person. In certain situations, they could provide temporary breathing room or help someone enter the housing market earlier. But the key issue is whether they are being used as a strategic option or a systemic fix. If they become the main solution to affordability, they risk turning housing from a path to stability into a lifetime obligation. The deeper issue is that housing affordability is not just a personal finance problem. It is an economic design problem. When home prices rise faster than wages for years, stretching loans longer does not fix the imbalance. It just stretches the timeline people spend dealing with it. And that distinction matters, because a longer timeline can hide a worsening system. Instead of solving the pressure, it spreads it out. The real question is not whether a 50-year mortgage lowers payments. It does. The real question is what it does to prices, flexibility, equity, and long-term stability. Because financial decisions that look helpful in the short term can quietly reshape markets in the long term. And when it comes to housing, long-term effects matter more than almost anything else, since a mortgage is often the biggest financial commitment a person will ever make. In the end, the danger of ultra-long mortgages is not that they exist. It is that they can make an unsustainable market feel sustainable. They can create the illusion of affordability while the underlying costs continue rising. Illusions are powerful because they do not feel like risks until years later, when the consequences finally show up. Housing has always been tied to the idea of security, but the structure of the loan determines whether that security is real or just temporary relief. So before accepting longer mortgages as the new normal, it might be worth asking whether they are actually solving the housing crisis, or just making it easier to live inside it.